Hello, welcome back. Docusign is a company for which we have talked in the past, although it's been a few months, and things happened. And right now the stock is down 24% after hours. It looks like it's trading near $66 in the after hours market after reporting earnings. So we're going to examine what happened here with the company after they reported their earnings today. If we take a look at the stock news here, you will see that Docusign tanks 25% on Q1 results. They'll be impaired in long term. So let's examine what happened with the earnings report here after they actually miss earnings. So they delivered 25% revenue growth from a year earlier, but investors are increasingly concerned with profitability. So remember, we have long talked about profitability in this channel. We are massive proponents of profitability. We don't just want stocks that are increasing their revenue. We also want them to be making money and good money on top of their revenue. And so right now, as we're entering a more cautious time for trading and holding investments, we want to be making sure that we are buying the ones that are making good cash flow, good free cash flow, and they are not just making sales without any profit. So this is why the stock is actually down about 24 to 25% right now in the after hours market. Here's what the company did: 38 cents per share versus 46 cents per share that was expected. So that's a significant decline in earnings, and revenue of 588 billion versus 581. This is better, but again, we are talking about less in profit. So at some point the company has to become profitable, otherwise what are you buying really? And so investors shift away from a focus on growth to profitability. And again, profitability is the most important thing, especially now that we're entering an inflationary environment, and it's gonna be weaker for companies that are not posting good profit here. We are seeing all these companies that have been potentially growth stories pretty much, or at least regarded to be so by some investors, pretty much tank, because again they are not making any money, and so investors have to pretty much ditch them, because this is not the time to be owning this kind of speculative investments right now. You want to be owning the very best ones in this current market. And so the article pretty much finishes here, with expectations for 2023, for the second quarter and all that. But what we want to do here is examine the financials. So we're going to go to our stock analysis tool here, which will help us determine exactly what is going on with the company. Remember that you can become a patron and gain full access to this website by visiting the link in the description box below this video. Now, you will see here in the last 5 years, again, when interest rates were low, when the whole environment was great and every stock was cooking, and pretty much people were buying anything in the stock market or everything, you will see here that the stock was having a field day. But during the current slump, it's down 72%, and it's bound to be near maybe like 80%, 85% tomorrow after this massive decline today. You will see that the P ratio of the company is very negative, minus 196 that would be, and price to free cash flow positive. Now you may be wondering how this is happening. We will examine that. Outstanding shares up 50% almost. So the company has been issuing shares because they are not making any money, and so they need to be pocketing some money either by debt or by issuing more shares to hungry investors who want to buy more of these things, and basically funding themselves through that. But what are they really returning to their shareholders is the question. So they're returning some revenue growth, but net income, this is actually going down. And it is a little bit better in the previous years, yet it's still in the negative. And this company is trading at, or at least was trading at some point at $300 with a $17 billion market cap. So the free cash flow has been increasing here. Again, that's a little bit of a weird one. We will examine why that happened. And total equity growth has been increasing as well, more than likely because of the outstanding shares here. Although overall it had a massive increase here in 2019, and then it went down pretty much every year. Now the debt that the company has is quite significant here, 3 times its equity here, and so that is interesting to examine as well. But of course the profitability of the company is negative. Very interesting to take a look at the income statement here and the other financial reports. 500 million to 2.1 billion. Yeah, there is some growth here, but it's not tremendous growth, especially for a company that needs to be growing fast. This is supposedly a growth story, so I would expect them to do better here, frankly. It's not horrible, of course, but again, you need to see some explosive growth from these kinds of companies, and especially when they're not making money. And they're basically doing the same that they did 5 years ago. This is what they lost last year, and so that's not something great. And in the meantime, they have been losing even more money, so they haven't reached profitability yet, it looks like. And in terms of their balance sheet, as you can see here, total equity has been the same, increasing a little bit, but overall very similar to what it used to be. And through the years, take a look at the extra money that they got from additional paid-in capital here. They have vanished because of the liabilities that the company has, at currently sitting at 2.26 billion. This is a small company, so we are just looking at a couple or 3 billions or something of that sort. But take a look at the retained earnings, pretty much getting more and more in the negative over here, so the company is losing money every year. Not great to see. In terms of the cash flow, this is interesting here. In terms of percentages, you were looking at a massively more operating cash flow compared to the net income, and this is indeed the case because of stock-based compensation. Remember that stock-based compensation is an expense for a company, but it affects net income. It doesn't affect the cash flow because it is not paid in cash, it is paid in stock. And so the free cash flow, the cash flow statement is about the actual cash. It has to be cash. Otherwise, it has to be deducted, it has to be extracted from the cash flow statement. And this is why it's added back, because it is not a cash expense. It was deducted from net income, it needs to be added back here on our operating cash flow. And this affects our free cash flow here. But it's not coming from profitability is the big problem. And this is why my discounted cash flow model actually uses the profitability variable. It uses the relationship between net income and free cash flow. And this will actually help you catch these kinds of situations here without even having to look at the cash flow statement. And I'll tell you what this means when we look at the stock evaluation tool. Cash from investing activities in the negative as well. Over here you will see minus 162. That's a good thing overall, of course, because they're buying some investments here. But financing activities also negative, paying off some debt. You will see that they have about $500 million in cash and free cash flow 445 million here. Now, if we take a look at the stock evaluation tool, it will paint a quick story of what the company is doing here. We can take a look at the net income. You'll see here that every year it's negative. And so our free cash flow margins, remember, they depend on the net income. It's a free cash flow margin compared to net income, not revenue. And so this being in the negative already tells us that we are looking at a non-profitable company, and we cannot really deduce what kind of free cash flow the company is going to be generating because it hasn't been profitable. Even though you are looking at positive free cash flows here, these are not coming from profitability. They are coming from accounting adjustments. Very, very important, and this is why my discounted cash flow model uses the free cash flow to net income margin instead of the revenue. This is the core reason behind that. This will actually already give you the story of this stock without even having to run the tool. Now, let's just say that the company will continue having explosive growth for the next 5 years. Let's go 20, 25, and 30%. Which again, maybe we would expect even better from this company, but this kind of growth is pretty good as well. And net income margin, remember, this is in the negative. We want to deduce that the company at some point will achieve at least marginal profitability, so we're going to go 1, 3, and 5 here in terms of the net income margin that the company will eventually generate. They seem to be doing a little bit better, like now last year they did minus 3%, maybe it's gonna get better, who knows, although based on the reports, that's not looking like it's going to be the thing, at least for the next year or so. The free cash flow margin, again, look at this one, very negative here compared to the net income. And so we don't have anything to use here in terms of actual numbers in the past. So we will go with something that, generally speaking, makes sense, 80, 90, and 100. And what does that mean? This means that we're taking 80% of the 1% of net income margin here for our free cash flow margin. This is effectively 0.8% here. And the annual return is 13%, what we need to be making pretty much at the end annually from our investment here. And if we hit calculate, what are we getting? Yeah, you will see that we are very, very far. The company is massively overvalued, as you would expect, even having dropped 72%. you just can't buy this one. It's not making any money, and especially this current environment, I fully expect this one to go even lower. Now, this is not the actual price because right now in the after hours it's trading at $66, but still we are far from where we would like it to be. This would have to go down significantly in order for me to even consider buying it, like very significantly. So yeah, this one is not a buy for me, but it may look more interesting to some of you guys. Give me your opinion. Let me know if you're holding the stock or what you're thinking about it. Leave a comment below, and remember to like and subscribe. Liking helps a lot, helps kind of promote videos to other people as well, and build a community here. Thanks for watching, and I'll see you in the very next one. Bye bye.